You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Despite Ireland's bailout, concern over European sovereign debt problems were still on investors' minds this week, but hopes for aid to Europe coupled with some upbeat U.S. economic news helped ease some of the gloom that had gripped the market. The news included improvement in consumer confidence, positive retail sales reports, and a rise in the National Association of Realtors pending home sales index of 10.4% in October. The Dow finished November down 1%, its first down month since August, but then the bulls came charging back to make December's first trading day for the Dow its best since September the 1st. But hopes for a self-sustaining economic recovery were a bit dampened on Friday, when it was announced U.S. employment increased far less than expected last month, pushing the jobless rate to a 7-month high of 9.8%. And we'll be talking more about that later on the roundtable. Right now, though, we're going to bring in our market technician, Kevin Matris, to talk some technicals on this stock market. So, from a technical perspective, what are you seeing?
Well, it's interesting because, if you take a look at what's been happening in the market lately, we have broken through a long-term descending trend line, and that happened in September. And if you were to look at this trend line, that trend line dates all the way back to the highs of 2007. So when the market broke out in September, it did so at 10,840. And within weeks of that breakout, we saw the market shoot up to as high as 11,451. That was about a 5.5% return. What's interesting is that afterwards, we did see the market pull back. It pulled back to somewhere around 10.9, which was essentially the breakout point. I think that happened earlier this week. But the market has since bounced back. We're trading somewhere around 11.3, and it does seem as if it is now poised for a move higher.
So what does all of that mean to that move higher or possible move higher?
Good question.
That's why I asked it.
What I see is this. If you were to look at this from a technical perspective, the recent consolidation pattern was about 1,380 points. So what a technician will do is he will add that to the breakout point of 10,840. So 1,380 plus 10,840, that equals a price target of 12,220. That's another 900 points from here, or about another 8% higher from where we are today. What's exciting, though, is that if you were to look at the indices, if you're looking for an 8 or a 10% increase on the major indexes, you could probably see a good 20%, 30%, 50% on a lot of good quality individual stocks. Now, granted, this is all assuming that there's no catastrophe out there. There's plenty of problems here in the U.S. as well as abroad, especially abroad. But if you can continue to see the economic numbers improving, the unemployment report notwithstanding, I think not only can you see the market go to 12.2, I think this trend could continue probably for a couple of years. All
right, so give us a little bit of a weekend wisdom rundown from your technical perspective. What is the best way for investors to capitalize on all of this?
Well, what I would say is there's really two key things if I were to really narrow it down to just two choices. I would say the very first thing you would want to do is focus in on the top industries. Half of a stock's price movement can be directly attributed to the group that it's in, and our testing has shown that even a mediocre stock in a top group will oftentimes outperform a top stock in a poor group. That is how important it is to get into the right groups. And our testing has shown that the top 50% of industries actually outperforms the bottom 50% by a factor of 4 to 1. So definitely focus in on the top industries. The next thing would be look for sustainable growth. Everybody is looking for growth, but you should know that companies with a double-digit growth rate actually perform better than companies with triple-digit growth rates. It does seem a bit counterintuitive, but it makes sense because those kinds of companies are priced for perfection. So if you're looking at a company with a triple-digit growth rate or even more, even the slightest downward earnings estimate revision can send that stock falling. So people wonder, oh my goodness, how can my 300% growth rate stock possibly be going down?
Yep.
That is why. So I would take a double-digit growth rate over a triple-digit growth rate any day. And if you follow those two key steps amongst, a bunch of other things, but if those were the things you focus in on, I think that will give you an advantage for this next leg up in the market.
And if you had to squeeze one more way out, what would it be?
One more, I would say, look at value. Everything being equal, value stocks have outperformed all other styles over the long term. So everything being equal, a lower value company is better than a higher value company any day.
All right, what's on your radar for the week ahead quickly?
I think as long as we can hold this, 10 to 11, or excuse me, 11 to or 11,000 area, I think we'll be fine. But if we can bust through the highs that we had seen, that 11,451, I think this is going to be the beginning of a much, much larger move.
Okay, so you haven't lost your enthusiasm for the market.
Not yet. Not yet.
Apparently. There's more still ahead. Kevin will be with us throughout the whole show, so you'll want to stay tuned for his different parts of the program, including the roundtable. Here is your Bull and Bear Stock of the Week. An insurance company and a private school are this week's Bull and Bear of the Week. Here to tell us more, Shiraz Mian, Research Director. Yeah, that is you, isn't it? Didn't recognize you there with the new look.
A little change.
Yeah, change is always good, I guess. Aflac is the insurance company. I like that duck. Aflac.
That's right. The duck, surprisingly, is a very solid defensive stock, and that's the primary reason for picking it as the bull of the week. The two main attributes I want to focus on. Number one, the solid conservative business model and operational practices that the company is famous for all along. And number two, they're very good balance sheet, cash flows, capital ratios, and payouts to shareholders. So just briefly on the conservatism of the firm, and just one little factoid about the firm, it's a U.S. insurer, but more than 2/3 of its revenue comes from Japan. It's one of the largest operators over there.
Wow!
So about 70% of its revenue comes from Japan, and about 30 or so from the U.S. Their investments, their underwriting standards, they never let go of the internal rules that they had even in the bull years, and that kept them in good stead. When the downturn came in late 2008, they had none of the issues that many of the other insurers felt in their balance sheet, who had these mortgage-backed securities and all of these others. So all along, they took the downturn and all those issues in the stride, primarily on the basis of their conservative underwriting standards. The balance sheet, as I referred to, is very good. The debt to capitalization is around 20-25%. They produce a ton of cash, and they don't shy away from sharing it with shareholders. They recently increased their dividend, and it currently yields in the 2.5–2.4% range. So a good, solid, conservative pick that would ride investors, help them ride the relatively volatile months ahead.
Okay, and a very strong brand name as well.
Very strong brand. Of all the surveys that show whether it's work conditions, whether it's customer loyalty, it always comes to the front. So a very strong brand.
All right, Capella Education Company is the bear of the week. Quickly, what makes them a bear?
One reason, it's the regulatory overhang. This sector went through a strong growth phase over the last few years. The overall environment is still supportive in the sense that we have a lot of weakness in the labor market, and that kind of pushes folks to go and spruce up their skills to make them more marketable. But over the past 6 months to a year, the Department of Energy is looking more into the business practices of this group, primarily with respect to how they attract students into their programs, and then what is the future outlook of those students once they graduate. And there is a number of things that are not as attractive as the market believes, and that's something that'll weigh on this on Capella.
All right, we need to leave it there. We're screening for stocks next. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. This week we are screening for high beta stocks. Kevin Matris, that stock screening expert, with us once again.
I love when you say that, Terry.
I had another name actually, but I reverted to expert to explain all of this.
Wonderful.
So high beta stocks, in my mind, equates to high volatility. Is that right?
Right. Well, you know, it's funny because a lot of people, when they do screening, oftentimes they will look for companies with low beta stocks, which typically means lower risk or lower volatility. But we are going the reverse this time, and we're going to be looking for companies with higher beta stocks. So let's start off with the definition of what beta even is.
All right.
Beta, first and foremost, is a measure of an asset's risk relative to the market. Normally, it is being compared to the S&P. So a beta of 1 means the stock's relative volatility is equal to that of the market. A beta of greater than 1 is more volatile than the market. And a beta of less than 1 means it is less volatile. So for example, if you have a beta of 1.5, that means that the stock's movement should be 50% more than the market. And that means if the market is going up, your stocks indeed should be moving up 50% more, but that also means if the stock is going down, typically, or if the market is going down, typically your stocks would be losing more than the market.
So does that mean if stocks are going up, then these stocks do pretty well? Or if the market's going up, these stocks do pretty well, but if it's going down, they get crushed?
Well, that is the general premise behind this whole thing. However, though, what's interesting is that I ran a bunch of tests, and I found out that it doesn't really work out that way all the time. So a couple of tests I ran was this. The first one was for stocks with betas half as much as the market, and the other test was for stocks with betas 50% more than the market, and the results were very interesting. So check this out. The high beta stocks using a 1-week rebalancing period between January of 2008 and March 6, 2009, which was the low of the market, high beta stocks lost 60% while the market lost 50.1% for an excess loss of 9.9 percentage points. The low beta stocks lost 43% versus the S&P's minus 50, meaning it lost less by roughly 7.1 percentage points. However, during the period from 3/6/09 to 11/19 of this year, that's the period immediately following the market's low to the present, the high beta stocks showed a compounded return of over 213% versus the S&P's 81.6, which is more than 2.5 times the market's return. The low beta stocks, however, showed just a 52.3% return, which is well under the market's 81.6% performance. So the high beta stocks showed more movement, but they didn't lose anywhere near as much as the market when it went down. However, they actually performed staggeringly better when the market was up.
Quick parameters.
Yeah, the screen that we're looking at today is we are focusing in on beta. So we want the beta to be greater than 1.5. We want the 1-year projected growth rate to be greater than or equals to the industry's median. And then we want the last EPS surprise and the last sales surprise to be greater than 0 and a price to sales ratio below the median for its industry.
And just give me a couple of quick stocks that came through.
Sure, there's 5 here, but you can see from this list Asbury Group, Ultra Holdings, CB Richard Ellis, Deluxe, and Newport. Bunch of diverse stocks from a diverse set of groups. Fundamentally strong, technically strong. They look like they're ready to outperform the market.
Do you own any?
I do not have any of those, so I had to give a second look.
All right. We appreciate the time that you took. We'll look forward to seeing you at the roundtable.
Okay.
You stay with us because the roundtable is next. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, the jobs recovery, the Santa Claus rally, if there is going to be one, and top stock picks of the week. That's all on the agenda for this week's roundtable with Shiraz Mian, our research director. Our market technician, Kevin Matris, and equity strategist, Tracy Reinick, joins in the fun this week at the roundtable. Jobs recovery took a little bit of a step back, Shiraz. We found out yesterday morning jobs were up only 39,000 in the latest month, well below expectations, and the jobless rate inched up to 9.8%. So, does that really strengthen the case now for the Fed to move forward with its controversial plan of stimulus?
I think it does. I think it took everybody by surprise as to how the November numbers came in, and they literally fly in the face of all the key economic data that had been coming out since the fall, whether it's non-farm payroll, October, September, the weekly initial claims, the 4-week average of that, and even the other series. So the market, the range for the estimates for November, where the numbers came in was completely out of that range, and that's why it's a big surprise. And I before coming in, I tried to look for some silver lining and some positive, but unfortunately, I actually can't really report it. Yes, the October number was revised upwards a little bit. Yes, we had temp jobs. But the work week remained stagnant. The earnings number barely increased. All in all, a fairly bad report in my view. But the takeaway, in my view, will not be that we are going back into on the downhill in the labor market. I think it just shows that the recovery that we had been seeing over the last few months throughout the economy is in place, but the corporate sector is relatively more gun shy than we had been banking on. So it may take us a little while for these numbers to come back.
Kevin, does this dampen your enthusiasm at all for this recovery?
No. You know, if you were to look at this unemployment report, yeah, it was a big disappointment, and I agree with Shiraz, but it wasn't as bad as last month's was good. And the takeaway is that, yeah, we still did see job growth. It was very unfortunate that it was so tepid. I think we were looking for like 168,000. We got like 39,000. But it does show that we are growing. And if you were to combine the anemic but still positive job growth and the GDP that we just saw, which is 2.5%, and forecasts for 3% or more, if you can get GDP above that magical 2.5%, this is where you're going to be able to see the economy grow enough where you can keep the presently employed people at work, and you're going to be able to absorb new workers coming into the labor force.
But here's something that you and I were talking about before we actually started here on the program, and I think it's a valid point, and I'm just thinking out loud at this point. Where is the incentive for employers to commit to long-term hires when corporate profits for 2011 are on pace to shoot even higher?
I think it really does have a lot to do with the projections that we will see higher GDP. Because again, I keep talking about this magical number of 2.5%, but I think statistics show that once you get over 2.5%, that is where you do start seeing more people enter into the workforce. And more people into the workforce means more economic activity. More economic activity means more goods and services being bought and sold, which means the companies who want to get in front of this curve, they start building up their inventories, and they need more workers to be able to do that kind of thing. So that's the incentive, in my opinion.
Okay.
One quick comment on that with respect to your question. The company's ability to squeeze more profits out of the existing personnel will take them only so long. So that they have gotten and reached a stage where they have to add more people to increase the bottom line. So that'll be the incentive.
At some point, there's a tipping point.
That's right.
There. Okay. Tracy, what does this mean now, at least here over the short term, for December's market strength? Anything?
You know, it was pretty bullish going into this number, and a lot of that is because the retail numbers have just been outstanding. I mean, if you saw some of the reports that we had this week from the individual retailers, like JCPenney, it was their best Black Friday ever. The same with Victoria's Secret, and then they saw, you know, sales off the charts on Cyber Monday. So for some reason, we have this higher unemployment, but the people with jobs are back spending again, like maybe at like 2007 levels, some people are saying. So to me, the whole retail news is going to give a little bit of boost to the markets, and I think, you know, it wants to rally. I think we could see a good, maybe Santa rally this month.
Okay, so it's not out of the question yet,
No.
at least in your opinion. All right, top stock pick of the week.
I'm looking for Lubrizol, LZ. It's a fuel additives company. It's a conservative, stodgy, old-fashioned business. One of just a handful of companies in this business worldwide. Very solid balance sheet, extremely good cash flows, pays a decent dividend, and I think we'll keep investors in good stead over the coming months.
All right, Mr. Matris.
Fastenal, ticker FAST. They are in the buildings products, retail, wholesale industry. They sell a bunch of industrial products and construction products to a whole various set of industries. What they have is, though, that's so impressive, is they have strong double-digit growth rates. They posted positive earnings surprises and sales surprises their last time out. Their estimates are on the rise, and particularly what I like about the chart is they just broke out of a big 7-month-long base. I think they have the potential to get to around 65.80. That's about a good 20% from today's levels.
All right, Tracy.
I'm going to stick with the retail because I do like that story.
I kind of thought you would.
I know, and my stock is Fossil, which actually is really well known for its watches,
Yeah.
but they also do other accessories and stuff. But the fashion watches are really, really hot. Macy's said it was one of their biggest sellers in their last quarter, and Fossil had a 37% sale growth in their last quarter. The stock is at an all-time high, but it's not super expensive compared to its peers. So I kind of like the story, and they're hot in North America and Europe. So.
Yeah, what else do they do besides watches?
They do like purses, belts, things like that. They have their own
Accessories.
retail stores, but they also license out a whole bunch of different watch brands.
That's an old line name.
Oh, yeah.
Fossil, because of the collectible watches years ago that they used to produce. I don't know if they still do.
I don't know if they still do the collectibles, but you know they have a wide range. They do Donna Karan and a whole bunch of other watch brands now.
All right, we'll give you the final word. Thank you all for being here, and thank you for being with us this week as well. Hope the week ahead is a profitable one for you, and we'll see you next time right here on Profit from the Pros.